The public perception of crypto often stops at meme coins and speculative volatility. But while those headlines captured the attention of retail traders, institutional desks began integrating blockchain directly into their core settlement architecture. The friction in current finance is a matter of physics. On Wall Street, changing the owner of a stock still takes 2 business days to settle. Moving money across borders requires a chain of correspondent banks, each adding a layer of fees and a day of delay. To solve this, firms are migrating to the XRP Ledger, which recently saw its largest 30-day spike in tokenization history. These aren't retail trades. They are energy contracts and commodity ownership records being reconciled on a public ledger in real time. As these platforms scale, ledger-based reconciliation is shifting from a technical curiosity to a structural requirement for banks, needing to lower their capital reserves and match the speed of modern trade. For a blockchain to support that massive global volume, it has to overcome the inherent latency dragging down current networks. This makes Solana's Alpenglow consensus upgrade a critical technical catalyst for the coming year. Alpenglow replaces the current relay system with 2 new components. Rotor handles data distribution across validators, while Voter serves as the finalization layer, making transactions irreversible instantly. This reduces scarnality from 400 to 100 milliseconds, settling transactions faster than a human blink. Reaching this 100 millisecond threshold is what allows high-frequency trading desks and global retail point-of-sale systems to migrate their volume onto the blockchain, without the lag that plagued earlier designs. Speed provides the track, but real-world assets provide the cargo. Tokenizing reality means taking a physical asset, like a gold bar or a treasury bond, and representing its ownership as a programmable token on a ledger. This solves the problem of liquidity. Normally, you cannot sell 1/1,000,000th of a commercial office building. Tokenization shatters that barrier, allowing a single massive asset to be split into tradable microshares. It also changes the nature of access. By lowering the minimum investment, it allows retail participants to hold stakes in private equity or infrastructure projects that were previously restricted to the largest institutional funds. And it eliminates the risk of the settlement gap. Instead of waiting days for a bond trade to clear, the exchange of the asset and the payment happens simultaneously on-chain. This convergence creates the rails for a portion of $100 trillion in global assets to move from slow, isolated ledgers into a high-velocity, programmable environment. While assets are being tokenized, the way we move cash is also being overhauled. The current SWIFT system is opaque and slow, often taking up to 5 days to settle a single cross-border payment while accumulating middleman fees at every hop. Ripple's technology uses XRP as a bridge to bypass that entire network. A transfer from Seoul to New York that used to take days now settles in roughly 4 seconds for a fraction of a cent. Major South Korean banks are now adopting this for their remittance flows, providing a massive real-world validation of the network. This institutional interest is coinciding with the Genius Act, which aims to provide a clear legal framework for stablecoins and digital settlement. For banks, that legislation is the signal they have been waiting for. Regulatory clarity allows them to deploy XRP-based settlement products without the legal uncertainty that previously constrained their adoption. But building a global financial system on code requires accounting for long-term security threats, specifically quantum computing. Most blockchains rely on math that a sufficiently powerful quantum computer could eventually solve to compromise private keys. To mitigate this, groups like Paradigm are already developing rescue paths. These would allow Bitcoin holders to timestamp their ownership and move their funds to quantum-resistant addresses well before the technology poses a practical threat. While this threat is years away, sophisticated investors monitor these infrastructural safeguards as closely as they do the quarterly adoption metrics. This institutional shift creates a specific framework for a 2026 watchlist. At the core are the Layer 1s, Bitcoin for value, Ethereum for its RWA dominance, and Solana for the speed required by the Alpenglow upgrade. The second tier is payment rails. XRP remains the primary asset here, specifically because its utility for cross-border banking is now being validated by both regulators and major financial institutions. Finally, look at the RWA infrastructure. These are the oracle networks and compliance layers that provide the data and legal bridges necessary for trillions in traditional assets to function on a blockchain. Just as importantly, you have to ignore the noise. Projects with anonymous founders, unaudited code, or centralized control are remnants of the speculative past. They do not fit into this institutional future.
The next cycle is being built on actual utility and regulated infrastructure. The projects meeting those standards are the ones that will define the next decade of finance. Let me know in the comments how you're weighting your own portfolio for this transition. Subscribe for more data-first research, and I'll see you in the next one.